It's Wednesday, May 24th. You're watching the Daily Market Comment by Mario Sachikiriakos. I'm Christina Marujos, and thank you for joining us here at XM.com. There is a sense of caution in the air, with equity sliding yesterday and the dollar finding some demand through the safe haven channel. Expectations on the Fed's rate path have changed quite drastically and higher for longer direction. Market pricing currently assigns almost equal chances for the Fed to raise rates in July, while rate bets have been mostly unwound following a streak of encouraging data releases. This recalibration of the trajectory for interest rates was clearly reflected in the US dollar and US yields, which have been grinding higher in the last couple of weeks. However, equity markets have turned a blind eye, with the tech-heavy Nasdaq rallying in unison with yields. That's strange, as rising yields are theoretically bad news for riskier plays like stocks. It seems that stock markets are no longer trading the Fed, even though the dollar and rate-sensitive assets like gold are still tuned in. In the United Kingdom, inflation numbers for April came in way hotter than expected. The core CPI rate defied forecasts and instead stormed higher to hit a new three-decade high, reigniting concerns that the Bank of England has not done enough to extinguish inflation. Sterling initially received a boost, but those gains quickly evaporated, perhaps on the realization that the Bank of England might need to hike the British economy into recession to squash persistent inflationary pressures. Over in New Zealand, the Kiwi tanked following the Reserve Bank's decision. Even though the RBNZ raised rates, the overarching message was that this is probably the peak for rates. Traders will keep a close eye on the minutes of the latest FOMC meeting later today. The underlying question is whether further tightening is on the table, which Fed members currently seem split on. In the political sphere, the debt ceiling negotiations seem to have stalled lately, and nerves about a U.S. default are rising. A catastrophic default suits neither party, so some compromise will ultimately be found, even if the government shuts down. However, the real risk is what will happen after a deal is reached. That's when the Treasury will scramble to raise its cash levels by sharply boosting borrowing and flooding markets with newly issued bonds. This process can amplify the effects of quantitative tightening, draining liquidity out of the financial system and effectively sucking the oxygen out of the room, thus leaving riskier assets such as stocks and cryptocurrencies vulnerable this summer. Thank you for watching the Daily Market Comment here at XM.com.